Traditional markets were down again today. Crypto relatively flat ahead of the Fed news tomorrow. So we're going to take a look at the markets, see what happened today, and talk about what happened the last time the Fed raised rates in crypto, Bitcoin, crypto, and the stock markets. So markets are, a little bit flat today. Dow Jones, S&P down a little bit, half a point, 0.38% on the S&P, flat on the NASDAQ, up 0.18%. And of course, all eyes are on the Fed right now and what they're going to do tomorrow. Also, the 30-year mortgage just topped 6.28%, first time in the sixes. And I don't know how long. I'd have to go back and look and see when the last time interest rates were in the sixes. But my guess is that's going to be somewhere in the early 2000s, late 90s, early 2000s. I don't know that they got above 5% really anytime after that. So the housing market is the adjustment in the housing market correction is going to accelerate. So if you're looking to buy a house, prices are going to be adjusting fast. Inventory is going to rise, and the housing market is going to correct because, as we've discussed many times in the past, it's all about affordability. That's what the housing market is all about. Here's Bitcoin on the hourly, and obviously, big downside last couple of days. Let's take a look at Bitcoin on the daily here. Nice little capitulation drop there ahead of the Fed meeting, just like traditional markets. Of course, Celsius is playing into some of this a little bit, but really at the end of the day, it's the traditional markets. Even, the Celsius stuff's not a big deal. Terra Luna stuff's not a big deal. This is all about the Fed. It's all about the global macroeconomic picture. It's all about inflation. When that inflation print came out hot, the markets knew the Fed was going to have to act. So it's getting ahead of the Fed in terms of price drops and looking at what the Fed is going to do tomorrow. If they do a 50-point basis, they do a 50 basis point hike, then the markets might drop a little bit more because the Fed has already lost credibility and they're going to be bordering on incompetency if they don't act swiftly to get inflation under control. Markets will react negatively to 50 basis points because that just tells them the Fed is completely clueless and doesn't have the willingness to attack inflation, which is going to be way worse on the economy than markets and assets devaluing and getting delevering, selling off, things like that. So inflation is worse for the economy. Stagflation is worse for the economy than the markets crashing, and we're nowhere near crash levels. Markets are just now entering bear market territory significantly. And when you go back and look at the S&P, and if you look at where we're at right now relative to where and what happened in 2018, the last time the Fed tightened, down 22%. 2018, when the Fed tightened the last time, market dropped, I think probably about the same before they reversed. 20%, somewhere in that neighborhood. Pre-pandemic levels, still a ways to go to get there. And when you compare it to the 2009 crash, nowhere near 2009 crash levels right here. The great financial crisis, the market S&P dropped 57%. So, lots of room for this correction to continue and unwind what's going on. 26-30% would be pre-pandemic levels, which I'm kind of targeting. 57% would put you way back down to basically levels we haven't seen since 2015, 2016, somewhere in that time frame. Not saying that's going to happen, just saying that there's a lot of room there that can unwind. But let's take a look at Bitcoin here. Here's the dominance. Been down the last couple of days as some of the altcoins have been kind of gaining strength against Bitcoin. Here's Bitcoin on the daily. And of course, all eyes are on the weekly time frame here and the 200-week moving average. And the big question is Bitcoin going to lose the 200-week moving average and turn that into resistance and continue down? Or is it going to find support right here and just continue to consolidate sideways while the global economic situation works itself out and the Fed can stop the tightening and markets can continue and go on another bull run? And as we know, crypto winter can last a couple of years. Bear markets, the 2018 bear market, traditional markets lasted, basically the sell-off lasted about, let's go ahead and take a look at this. It was about 3 years. So the sell-off in traditional markets in 2009, the great financial crisis, this drop right here alone, just the drop, took basically from October of 2007 to get to the bottom. It was March of 2009. So about 18 months, somewhere in that time, or yeah, about 18 months in that time frame. Let's look at that again. 72 weeks basically is what that took. So actually a couple of years for this market to bottom when it started selling off. So that's how these bear markets work. This, looks rapid, but this could go on for another year to 18 months of downward, with bounces kind of working its way down to find a bottom. As long as the Fed keeps tightening and keeps raising interest rates, if they pull the foot off the brakes and stop raising rates and stop, unloading the balance sheet, then markets might be able to recover, stabilize, and maybe go on a little bit of a run. But this was all, stimulus right here. Quantitative easing, liquidity being pumped in the market, fiscal stimulus, monetary stimulus, pretty much everything was pumping these markets up and going parabolic. So anyways, let's get back to Bitcoin. And we've been following the 200-week moving average and also the Gaussian channel, starting to turn red here for the last few days. And as we know, the last time the Gaussian channel turned red, it was about a 39-week period. This is on the weekly. So we could have several weeks to go here. It's only 3 weeks in if it follows suit according to past timeframes. Let's take a look at the hash ribbon indicator. So this is the signal that I've been watching here, and price has started dropping right up in this area when that signal first flashed, and is continuing to work its way down. Last time we saw that, that was last summer in this time frame, and price dropped, from the time the signal really flashed right up in this area. Well, let's just take the maximum drop from peak to trough when that signal flashed in this little range here. It's about 28%, and we probably have already done that right here. But of course, that was a different macroeconomic time frame there. Price has already dropped, 33% to the wick low, close low 29%. So it's already unwound that on the capitulation signal. The miners are capitulating, they're losing money, so they're having to sell. But here's what I want to take a look at. So what happened the last time the Fed raised interest rates? Because the thinking is if they only raise 50 basis points, the market might, really throw a fit because the Fed's just at that point, they're incompetent, they're way behind the curve, and they're showing that they have no clue how to get a hold of inflation and control things. If they raise it 75 to 100 basis points, the markets will probably rally on that news initially because, hey, the Fed's going to be serious about this. They're going to get this under control. And then it might, start to, realize, wait a minute, if they're raising 75 to 100, that means bad news for the economy. So then, we might see another leg down, the next leg down in the markets. And as we've seen, these are just levels that the markets have been going through every time the Fed does something. So when was the last time the Fed raised rates? Right here, May the 4th. So the Fed raised the rates 50 basis points, May the 4th. The market, crypto, Bitcoin, here's Ethereum right here, May the 4th. Avalanche, pretty much everything. We can look at the total altcoin market, May the 4th. Everything bounced on May the 4th. Traditional markets, same thing. Here's May the 4th right here. So everything bounced, and let's just go back to Bitcoin, on May the 4th, and then dropped 1, 2, 3, 4, 5 more days after that. And what was that drop? So from the peak of the bounce to the wick low was 36%, but it closed, on this range low about 28%. So markets dropped 28% after a 50-point basis hike. So let's just assume that, the market's going to do the same thing right here after that happens. So let's say market pops up. Let's just give it this candle here to 26,000, drops, another 28%. That puts it around 18, 19,000. So that's that $20,000 range, potentially getting tested if the markets drop like they did last time. And let's take a look at the Dow Jones and the S&P and see where that lands those. Well, let's see what the market did back then on these right here. Where did May 4th go? Right here, here it is. Okay, so the market dropped. Let's take a look at that. So the market dropped from the peak down to the wick low. Wasn't so much, 8% for traditional markets in the Dow. So if we drop 8% from, let's just say here, drops down another 8%, puts the Dow down somewhere around 28,500, somewhere around there. S&P, there's been a lot of projections about S&P in the 3,000 range. So let's just say 8% down from there, puts the S&P at 3,500. And what did the S&P do? Here's May 4th, probably about the same thing, probably in wick low 10%, but settled in at about 8-9% drop. NASDAQ, same thing. So very interesting. Had a pop on the news on the actual day the rates raised. Well, NASDAQ dropped 13%. So that's, potentially another 13% from there, puts the NASDAQ down. And I'm just kind of giving it a nice little bounce there. 13% puts the NASDAQ down around 10,000. So it'll be interesting to see what these real results look like and what really happens off the news of the Fed. But anyways, that's my thinking in terms of, what I'm looking for tomorrow out of the Fed. I think we're going to see 75 to 100 basis points. I think the Fed needs to show they're serious, that they understand there's a problem, that they made a huge mistake, that they are willing to do what it takes to get control of the markets, get control of inflation, and lead the economy out of the situation. Now, here's the thing. The Fed cannot create demand. Not demand, they're destroying demand. They cannot create supply. The Fed cannot solve the supply issue. They can only destroy demand, which kind of helps bring the supply demand back into balance. That's why they want to, curb asset prices. That's why they want to curb, the housing market. These are intentional moves to destroy demand so that the supply can catch up and things can balance out. And it may take a while. The last time we saw, a financial crisis was 2008-9. It was very different. It was a banking failure. It took, as you saw, a couple of years for that just to find the bottom. But that bear market played out for about 6 years. So bear markets and traditional markets can take a long time if you have a serious financial issue like we have now with inflation, things like that. And those are the signals to look for in terms of when's the market going to turn around? When can we look for a bounce and, bull market on? Is that we have to unwind as the Fed adjusts rates. The markets will continue to follow that lead and follow that action and adjust accordingly to interest rates, because that affects valuations. And just like it does in housing, interest rates affect valuations on stocks, on companies, and on other assets, as well as people's ability to borrow and spend. So those are real impacts on the economy, real effects on the economy. And that's why those things are important when you're looking at crypto, stocks, or any other assets. You got to keep an eye on the macroeconomic environment, what interest rates are doing, what inflation's doing. Those things are very critical and important to the overall health and price action of the market. So those are the things that I am watching and keeping an eye on. And we'll just have to wait and see what the Fed actually does tomorrow, what the effects are, and what it looks like and how it turns out. So I will see you on the next video.